For Nigeria, the progress on reforms and improving macroeconomic outlook is being potentially marred by a narrative that refuses to go away. That is on insecurity, as fresh incidents of kidnapping in Niger State hit the headlines. Nigeria Security Tsar, that's Nuhu Ribadu, met with U.S Secretary of War Pete Hegseth, which could be a healthy sign of better collaboration, especially on security intelligence. Nigeria needs to address these security issues and advance bold corrections to radically upgrade law and order with as much momentum as we have seen on the economy. Disturbances in these food-producing regions, if not quickly addressed, apart from the tragedy associated with loss of lives, will plague the agriculture supply chain and show up pretty soon in price pressures, which are beginning to come down. Investors have also started seeing Nigeria as a strong buy, but the vulnerability associated with impatience of portfolio investors, that's the major portion of foreign inflows, who can move out fairly quickly, makes the insecurity story a delicate space from an economic perspective. Emerging Value Insights is encouraged by the seriousness the government is according to addressing these developments and thinking through appropriate systemic solutions. But still on Nigeria and recent drops recorded in October inflation, the Nigeria Central Bank Monetary Policy Committee meets, that's Monday, Tuesday, to decide on parameters. There are many considerations, including the inflationary impact of the insecurity narrative and reported uptick in the October month-on-month inflation print. Economist Tilewa Adebajo comments on the meeting coming up next week.
The MBS recently released inflation data at 16%. However, there are a lot of issues as to how these rebased inflation numbers compare to the baseline inflation figures. So the MPC meeting coming up this next coming week is going to be a very important validation of those inflation numbers. How confident are the MPC numbers on this number to be able to convince them to drop interest rates? I think that will really be the proof of the pudding when it comes to this inflation rising down to 16%. Having said that, if you take a look at the old inflation numbers at 33%, our own analysis suggests that inflation numbers using the old rate would be anywhere closer to about 26%. So yet again, that might influence the decision of the Monetary Policy Committee.
Hello, this is a special weekend edition of Global Business Insight, where we dive into the headlines and bring perspectives to support understanding of the dynamic context. It was quite a turbulent week for Wall Street on Thursday. US stocks whipsawed with the Dow going up and down through 1,000 points, ending the day lower. Friday started higher for most of the indexes, later went down and rose up again before closing higher in another day of unusually volatile trading. Bitcoin also closed down 2.1% on Friday, is down more than 10% for the week. Another sign of the rotation out of risk assets. What we saw was extreme volatility that comes as many powerful winds from different directions created unusual weather conditions for traders. The headwinds included fear of a tech bubble, plus fears of overstated profits driven by playing down obsolescence factors and under provisions for depreciation. But there were more headwinds, released Federal Reserve FOMC, that's the Federal Open Market Committee minutes, and comments of senior officials stoked some hawkishness, which a few others tried to counter. The government shutdown and data fog could also be problematic for a data-dependent monetary policy committee. Another headwind for equities betting on a December rate cut. Meanwhile, comments from top U.S. Federal Reserve official, New York Fed President John Williams yesterday that interest rates can fall in the near term pushed likelihood of a rate cut at the Fed's December 9 to 10 meeting. The strongest tailwind, however, came from Nvidia earnings release, which should have dispelled fears of a bubble but ended up swinging like a double-edged sword. This release, to some extent, alleviated some of the prevailing concerns, but it also shifted focus towards other fundamental issues within the sector. While Nvidia's results were indeed impressive, they highlighted the increasing debt levels among the company's core customers, many of whom are themselves prominent players in the technology and artificial intelligence industries. The rising AI delivery obligations could, however, introduce new vulnerabilities for the market, particularly if borrowing costs begin to climb or revenues falter. Additionally, the intricate and far-reaching nature of Nvidia's supply chain was brought into sharper focus. The company's operations depend on a highly complex web of suppliers and logistics partners. Potential bottlenecks are not limited to the supply of advanced chips. They also encompass critical areas such as energy provision for data centers and the avoidance of logistical disruptions. Any challenges in these domains could have significant ramifications, underlining both the opportunities and risks tied to Nvidia's continued growth and dominance in the AI sector. Another tailwind, Walmart, that's another bellwether, saw its last quarter sales up nearly 5% in the US as inflation-stressed shoppers visited stores more frequently and spent more. E-commerce sales also were 25% higher than from a year ago. Walmart issued a bullish outlook, unlike other retailers like Target, Home Depot, and Lowe's, who had cut their profit guidance. And then we had a long-awaited U.S. jobs report, which also had mixed elements. The major downward corrections in previous months, the higher unemployment, the massive jobless claims print, the concentration of jobs added in a few sectors, plus an economy likely to have been hit by the shutdown, are all making the Fed decision in December much more complicated. When big wins like Nvidia FOMC narratives, fear of a bubble, a long-awaited jobs report, and earnings from the likes of Walmart rage simultaneously, like we saw last week, the volatility could lead to a vortex that demolishes realities as we are used to seeing it. The only response could be to take cover, find safety by diving out as much as possible out of risky assets, hurting assets like Bitcoin, and of course, waiting for normality to resume again. Indeed, the fears of a tech bubble may have slightly abated, but if there is anything we learned from last week, it is that this fear is far from going away. Now to more stories. S&P Global reported flash U.S. manufacturing PMI falling to 51.9 this month from 52.5 in October. The manufacturing sector accounts for 10.2% of the economy. The service measure of new orders received by factories dropped to 51.3 from 54.0 in October, while inventory was the highest in the service history. U.S. factory activity down to a 4-month low as higher prices curbed demand, leading to higher inventory and hindered growth. A more than 35% rally in Eli Lilly stock this year, likely driven by the strong growth of the weight loss drug market, has taken its stock up to $1 trillion in market value. This makes it the first drug maker to enter an exclusive club dominated by AI tech giants. And still in the US, the Consumer Financial Protection Bureau announced on Friday that it will continue supervising financial institutions on a limited basis in 2026. This is a shift from an earlier pledge by Director Russell Vogt previous statement that he was completely dismantling the agency. A scaled-down bureau will still retain its regulatory footprint, though the full implications of what was described as limited supervision remains unclear.
As this is the first G20 Leaders Summit to be held in Africa, it carries the hopes and must reflect the aspirations of the people of this continent and of the world. We should not allow anything to diminish the value, the stature, and the impact of the first African G20 presidency.
Leaders of the group of 20 top economies are meeting in South Africa today for a U.S. boycotted summit. The G20 hope to agree on a declaration drawn up without U.S. input, which focuses on addressing inequality and climate change. It may therefore highlight elements like financing the transition to green energy, ensuring the rush for critical minerals benefits producers, and having a more equitable system of borrowing for poorer countries. Yesterday, an independent director on the BBC's board, Shumit Banerjee, has exited following admission of an incorrect edit of a speech by President Donald Trump, and which also has prompted threats of a $5 billion lawsuit. Banerjee, who also serves on the board of Indian conglomerate Reliance Industries, is a former chief executive of management consultancy Booz Allen & Co., resigned a few weeks before his 4-year term was due to end, obviously to make a statement. And the big story next week could be the unveiling of Rachel Reeves' autumn UK budget, which could make or break Starmer's leadership of the ruling Labour Party. Business could be hit by an array of salary, pension and tax-related schemes as the Chancellor finds $30 billion. A lot could have been taken out following reactions to the earlier pre-budget speech. Banks may also be spared from increased taxes on incomes, while a so-called mansion tax could be levied on expensive homes. The opposition parties are consistently heaping the blame on Labour's inability to find the discipline to cut its bloated welfare spend, which has to be increasingly financed by higher taxes on business and the wealthy. Crude oil prices dropped about 1% on Friday to a one-month low as the U.S. pushed for a Russia-Ukraine peace agenda that could boost global oil supplies. Trump was reported to have told Ukraine and European officials there is little room to negotiate on the plan to end Russia's war, as the U.S. puts pressure on Zelensky to sign a deal drawn up by next Thursday. Apart from admission of Russian oil into global markets, the uncertainties stoked by highly volatile equities market, tepid global growth, and the U.S. interest rates trajectory are all heightening risk aversion, which of course weighs on oil prices. Brent futures fell 1.3% to settle at $62.56 per barrel. U.S. West Texas, that's the U.S. crude standard, slid to 58.06, that's WTI, $58.06 per barrel. And in the UK, the owner of the Daily Mail is buying the Telegraph, a rival British newspaper, for £500 million in a deal which will draw some scrutiny. Regulators will note that the pact would make Daily Mail and General Trust the owner of Fleet Street's most influential outlets, both known for being prominent conservative voices in British politics. Well, that's it on this special weekend episode of Global Business Insights. Enjoy the rest of the weekend, and thanks again for watching. This is Bode Oshosami. Bye-bye.